The economic data so far this week doing no harm to this equity market. S&P 500 futures just about positive by 0.1% on a 4-day winning streak on the S&P, about to make it 5, and the S&P trimming a monthly loss down to about 1.6%. 1.6% is nothing really at all, given the grand scheme of the rally so far in 2023. Place your opening bow, switch on the board and get to the bond market. The harm early this month done by surging bond yields. Over the last week, a whole lot lower. Down another basis point this morning at 4.1%. Remember, a week or so ago, a week and a couple of days, 436 on a 10-year, all the way back down, sub 4.1 earlier on in the last 24 hours. On a 2-year, quite a range this week, from 5.1% all the way back down to the 480s. On a 2-year right now, 4.89%. In the FX market, euro weakness. This is a problem. The euro against the dollar, 108.64. This is a problem for ECB President Christine Lagarde. What does she do on September 14th? Stuck between a rock and a hard place. That rock, sticky inflation, that hard place, growth, just ain't good. In the commodity market, just briefly, about 83 on WTI, an 82 handle, just short of $83 a barrel. Brent crude at the moment, WTI there, up by a little more than $1. One stock to watch at the open, Chewy. Evercore downgraded the stock. Analysts saying, quote, what makes us incrementally cautious is the disappointing second quarter decline in net ads, as well as management's subdued outlook for the second half. Abby has more. Hey, Abby.
Hey, John, and it's very disappointing to investors, too, with the stock now down about 11%, heading to its worst day since May of 2022. So they missed earnings in a huge way, down 61%. They put up at 4 cents, literally 4 cents in adjusted earnings. Sales were about flat, but, yes, disappointment on the part of the street that they would, Evercore ISI, as you were just mentioning, in particular, would prefer a more compelling valuation level, which is a way of saying that this stock is too expensive for the numbers that they're putting up. Morgan Stanley has kept their equal weight rating, saying that the negative net ads in the second quarter were offset by better than expected profitability, but the net ads have continued to disappoint, and the risks largely priced in ahead of the results. Well, I would disagree with that, considering that, again, that the stock is down about 11% on the year, or on the day, on the year, down 26% into today. So these results aren't shocking, but just disappointing to the street. I would add one more thing, John, which is there's a 17% short interest on this stock. So some investors today doing very well. These are probably the results that they would expect. It's also interesting just to think about all of the commentary out there about how Chewy.com is taking so much business from the smaller pet companies, and yet from a profitability standpoint, they're really having a hard time here, and from that net ad standpoint.
Stock down 11%. Abby, thanks for that. About 2 minutes into the session, 5th day of gains on the S&P 500. Longest winning streak will be closed here, going all the way back to the middle of June. No drama at the headline level on the S&P, just an inch higher by 0.1%. You want some drama? Check out this. Dollar General cutting its profit forecast for the second straight quarter on rising labor costs and softer sales trends. The CEO saying this: while we are not satisfied with our overall financial results, we made significant progress improving execution in our supply chain and our stores. Simone Foxman, that stock down 16%.
Yeah, shares fell about 20% last time it missed earnings last quarter, and this is the biggest drop since then. We're at the lowest level since March 2020 here. The results really pretty ugly. In the second quarter, comp sales actually fell slightly by 0.1%. They were anticipated to rise about 0.9%. The thinking that more people, a troubled consumer, would trade down and go to Dollar General doesn't necessarily seem to be so, because revenue from really all segments came in less than anticipated. But I think what really analysts are focusing on here is the guidance. Inventories have been on the rise, up about 8.5% from a year ago. The company saying it needs to invest there, also invest in labor to eliminate shrink, make the shopping experience better. All that is going to add up to a $170 million charge in the second half of the year, and therefore we see comp sales for the year expected to be either between -1% to 1%, where we were previously looking for 1% to 2%, and the street was expecting $10.03 a share. Now the company says $7.10 to $8.30. Paul Lejuez of Citi says this is a much bigger cut than we had anticipated, even though we did see one coming.
Simone, thank you. Stock lower by 16% about 4 minutes into the session. I want to turn to Shopify. The company striking a deal with Amazon to allow merchants who pay for Shopify's e-commerce tools to use the Buy with Prime logistics network. An Amazon executive saying this: we're excited to help merchants not only only grow their businesses, but also save time and resources. Katie has the story. Hey, Katie.
Hey, John. Yeah, Shopify soaring on the heels of this news, currently up about 6% from the bell. Now, with this tie-up, Shopify's U.S. merchants will be able to tap into Amazon's logistics network via its Buy with Prime tool. Specifically, that allows merchants using Amazon's payment and fulfillment services to include the company's checkout services and shipping guarantees on items that are sold on their own sites, which is interesting. So Amazon, it launched Buy with Prime last year, and at the time, this was seen really as an effort to blunt Shopify's momentum. But obviously, the optics a little bit different this morning. Now, the sell side broadly positive on this deal for both companies. Citi notes that this further enhances the value of a Prime membership, while you have Oppenheimer's Ken Wong saying that this should improve Shopify's merchant fulfillment experience. And as such, you can see both companies up this morning. Shopify, again, up about 6%.
Katie, thank you. Moving higher on that stock, turning to another earnings story, Salesforce, easing concerns about a slowdown, giving a revenue and profit forecast that topped estimates. However, Citi analysts saying the software company is, quote, not out of the woods yet, particularly with a continued tough macro environment. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Salesforce up 5.8%, holding its early gains from the open. The story really clear. Salesforce and CEO Mark Benioff really focusing on profit, listening to activist investors, which has been a story over the last 12 months. In July, Salesforce raised prices for the first time in 7 years. Job cuts have started to take effect. Salesforce talks about how headcount will be down 10% by the end of the fiscal year. And broadly, analysts are focusing on the outshining and performance of operating margins versus the slowdown in top-line growth. Revenue of $8.6 billion in the fiscal second quarter just gone represents year-on-year growth of 11%. Going to Citi's point, John, this is a company that on the top line has historically grown between 20 and 30%. There is a concern about growth long-term, but adjusted EPS of $2.12 per share, above analyst estimates of $1.90 a share. In June, Salesforce announced this new suite of artificial intelligence-backed tools. The per user, per person cost $7,700. So you go to the forward-looking guidance. For the fiscal third quarter, the period ending October, they see sales $8.7 billion, which is slightly ahead of what the street thought. But for the full fiscal year, they've also upgraded their forecast for sales of $34.8 billion. And key to what the sell side's latched in on, operating margins have been boosted by 2%, full year fiscal operating margin 30%. Sort of symbolic, at the beginning of the year, Bain Consulting carried out a strategic review of this company. It's now closed and finished, and the company kind of hinting that this is a part of the result that you're seeing.
Ed, thank you, mate. Stock is up by almost 6% right now, 7 minutes into the session. Here's a bullish view on the name from Dan Ives of Wedbush, raising his price target on the name from 240 to 255. Salesforce came out of the gate swinging, featuring a Djokovic-like performance. Classic Dan Ives. Strong Salesforce numbers and outlook is a huge barometer for the overall IT spending environment, with the street coming away with a more bullish vibe with the last few quarters. That stock is up by 5.4% to 226. Dan Ives at 255 now from 240. 8 minutes into the session, broader story, S&P up for a fifth day, this time by 0.25%. Jack Caffrey looking at the move in bond yields, saying this: all markets seem to be living in and reacting to the bond market's mood swings. The axis since shifted most recently to the idea of getting ahead of when the Fed calls it quits, with its hawkish rhetoric, forecasts and dot plots. Jack, I'm pleased to say, joins us right now. Jack, wonderful to catch up with you, sir. Let's start with the dividend growers. I know you like those names. Why is it a good time to shift to them right now?
Well, I think at the margin, if you start coming back to dividend growth, you're moving yourself away from the more extreme tails of the market, either the high secular growth names with embedded high expectations, and that to some extent might require a continued slowdown in the economy and a more dramatic decline in interest rates from here, or from having to make a call on whether economic growth actually reaccelerates that tends to drive the deep cyclicals. So if you will, dividend growers can be almost more core than core within the broader equity market and take away that need to be right on the timing, which has, I think, been troubling for a lot of people this year.
Jack, isn't
real
there
challenging, I should
a bond market call embedded in your call on dividend growers, though?
There is Yes, to the extent that we now live in a world where dividend yields are below bond yields, there is something there. But if you come back again by focusing on growth rather than dividend yield,
got it.
And so many investors conflate the two. When you think about dividend yield, most investors actually are saying high dividend yield, and those are like buying bonds. And if you're buying that sort of stock that has like 2-3% dividend growth, you actually haven't been keeping up with inflation over the last several years. And so you have certainly seen those stocks behave more like bonds than like stocks. Places like in the utility sector and some consumer staples. Coming back to perhaps lower dividend yields, but where dividends are growing at 7, 10, 11% a year, you actually wind up better protecting your purchasing power in an environment of still stubbornly high inflation against what the Fed would like it to be. And when we might start talking about how close to 2 is 2, is 2.4 close enough to 2 for the Fed to say we've won? And so come back to this idea that if I can double my dividend over 7 to 10 years, actually you get growth income. And I think that's what really drives purchasing power protection and ultimately becomes very powerful in the stock market over time.
Jack, you and I have talked about housing and the housing sector and the names around it that benefit from what happens there. This story now, this bullish thesis around home builders is so well understood given the distortions in the mortgage market. Jack, where are you now on that call for the home builders and the names that work with those names?
Well, I think when you look at the home builders themselves, to some extent it gets a little trickier here just because they effectively, they're helping support their sales by becoming bond traders themselves, effectively offering a buy down of current mortgage rates, tacking that onto your purchase price, but you can only do that for so long if interest rates remain sticky before you start having some more problems. But they really are the only material supply in the market. And so for someone who has to find a house or is moving or just is outgrown where they are, you're basically forced to look at new construction. I do think, though, that home improvement actually probably has more legs than people think, because this can become really the renovation economy. If you're looking at the average mortgage, 3.5% against a headline mortgage of 7%, you start thinking it becomes easier or more economical or more efficient to actually renovate your house, maybe add an extension than it is to actually take on a whole new mortgage, assuming you could even find inventory to buy. And so much of what I hear about is being cash buyers. So people aren't even interested in the mortgage market because they're being outbid for people who actually are desperate to find that new house, admittedly more in the suburban New York market, and where home builders really dominate, say, the southern markets where people have been moving to.
So, Jack, if we're in the renovation economy, can you help me understand the companies exposed to that? Is this the Home Depots of this world? Is it a company in the materials business? Where am I getting that exposure?
I think that you wind up actually, again, the easier exposures, the safer at night exposures wind up being the home improvement chains, which can actually benefit from, strong comps. A lot harder to have shrink when you start thinking about it. It's hard to carry a 2x4 out and not get noticed walking out the front door. When we think back to what we've heard over the last several days from retailers, whether it's in the discounters or other large retailers they continue for a year now. We've been talking about shrink this and shrink that. Harder to do with plywood and 2x4s. Now, I think when you start getting into the actual mechanics of what it winds up being sold, you do have issues with respect to supply chains still being unkinked within that. So I'd rather go more with simpler and easier trades where I have to get one thing right. People are fixing their houses rather than trying to guess whether it's paint, whether it's cabinets, whether it's plumbing fixtures. That gets a little bit more granular than my ability to actually make that right call all the time. And so I'd make it simpler and go to home improvement and get the broad theme right rather than having to be specific.
Jack, what you just said on the retailers, too true. I'm thinking of a name right now. I'm looking at Dollar General on the screen, down by more than 16%. Is your message, maybe not just for this name, but names like it, steer clear?
It's not steer clear, but on one hand, I'm not sure why the street is surprised by the Dollar General news this morning after the Dollar Tree news last week, which also reported many of the same themes and saw almost a comparable price decline. And I think you also then think about that and bringing this back to what's an investor's horizon. because clearly retail has been troubled, and it's been troubled for more than a year now, going back to Target almost a year and a quarter ago when they began talking about having challenges around inventory and having a mismatch versus what the consumer suddenly wanted. And when we now have higher gasoline prices, effectively pushing and pressuring that lower end consumer. The flip side, though, is when you think about places like the discounters, the dollar stores in particular, they are more rurally oriented, and we are, as a U.S. government, is dropping $1 trillion on those rural economies, which should ultimately be good for wages, should be good for jobs, and should be good for sales for those retailers left in those markets.
Jack, appreciate the update.
Not everyone can be served by Shopify.
I always do. And I'm going to be thinking of that line about not being able to walk out of Home Depot with all that stuff. Jack Caffrey, thank you, sir. Appreciate it. About 15 minutes into the session, equities up by 0.1%. Coming up, American Airlines flight attendants voting yes on a possible strike.
All of these strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages.
Team coverage up next.
All of of these strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages. So even if we saw softer jobs numbers, it could be because of strike effects. It could just be because we are in a tight labor market. We're running out of people to hire. Labor supply is still an issue here.
That was Citi's Veronica Clark weighing in on labour market conditions. American Airlines flight attendants, just the latest group voting yes to trigger a strike. The union writing this: "We are long overdue for a new contract. We are ready and willing to do what it takes." Votes tallying over 99%, paving the way for a possible walkout as early as November. Let's get to the team coverage. Bloomberg's George Ferguson with us from Detroit alongside Anne-Marie Hordern in Washington, D.C. George, first to you. We dealt with the pilots. Now we've got to deal with the flight attendants.
Yeah, so that's another agreement that's pre-pandemic as well, right? So it's waited a long time. The attendants look like they initially want a 35% increase, even higher than what the pilots were getting. I tend to think that's a bit too high. I realize that they're not as well paid as the pilots, and they probably want some catch up, but it seems to be a bit too high. It's probably less of an issue for the airlines. I mean, there's the pilots, we think they're about 25-30% of all labor costs. Flight attendants are going to be much less than that. They're probably sub $1 billion at an airline like American. That's probably going to make $2.5 billion this year. So to give them 30% is not going to add a lot to expense, but it's a continuing drumbeat at the airlines, right? There's a lot of unionized workers at the airlines. They all want increases, and it's adding up, right? It builds into the expense base, doesn't get unwound. It creates continued cost challenges.
George, just how understaffed are some of these companies, and have they learned to do a whole lot more with a whole lot less over the last couple of years?
So, I mean, I think it's really hard to do more with less, right? And especially the attendants, because the attendants are regulated by the FAA and the number you have to have on an airplane for it to operate. So you can't operate understaffed, but there's been a fair amount of turnover. And I think the challenge really at the airlines has been rehiring and then getting the training up to the point where they can operate at the efficiency that they were doing in 2019. I don't think they're there yet. They've gotten a lot better. I think turnover has stabilized to some degree, but again, more to go to get them back to 2019 levels of productivity.
MH, we talked about this a million times. It's like another day, another threat of a strike in America.
Yeah, that's right. It's really a hot labor summer. And what you're seeing is, as the economist pointed out, that you have a tight labor market, and the unions are using this to try to make sure they can get better leverage when it comes to contracts. I mean, you look at potentially this strike, it wouldn't happen until early November. There's also federal law, Jonathan, that makes it very difficult for airline unions to actually legally strike, and the president and Congress could get involved. But it was almost unanimous. More than 99% of these airline flight attendants voted to authorize this strike. And what you hear from the union is that they say that this is a message to the executives at American Airlines that flight attendants are fired up and they should take this strike authorization at their peril. So what they're really doing is just upping the ante and having that leverage to go into these negotiations.
Cameron Dawson called it hot girl summer. AMH, is that your line? Hot labor summer?
Hot labor summer. That's my line. It's even now in Urban Dictionary, because the individual who gave Biden and helped him coin the term that he wanted to be the most pro-labor union president in modern history, he kind of shrugged me off when I said, hey, it's a hot labor summer. And he's like, I don't believe what you're saying. I don't really believe that. But it's true. Look, we potentially might have auto workers striking as soon as September 15th. We still have the writers and the actors striking in California. We just had the UPS Teamsters. We just had the airline pilots. It is a hot labor summer, and it's in the Urban Dictionary.
MH, there we go. I'll be using that line. I'll be borrowing it and citing you every single time. Anne-Marie, thank you, alongside George Ferguson. About 23 minutes into the session, up here by 0.2% on the S&P with a sector price action. Here's Abby.
So not a lot of drama here for sectors, John. On the day, we are looking at a fifth up day for the S&P 500, possibly the longest winning streak since the middle of June. Right now, we have the best sector is communication services, followed by tech and discretionary, but none of them up more than 0.5%. Staples is the worst, down 0.3%. 0.2%. We also have healthcare down there. So the fact that the defensive sectors are down is actually risk on. Now, on the month, it's just so interesting what we're looking at. Most sectors are lower on the month. Energy and healthcare are the two sectors that are higher on the month. And then to the bottom, we have utilities. As you had mentioned the other day, utilities getting absolutely killed. But tech, John, really making a comeback at this point now, down just 1% or so.
Abby, thank you. Your trading diary up next with payrolls just around the corner. Five-day winning streak on the S&P. Stocks gaining across the board here. Let's get you to the trading diary. Broadcom earnings coming up after the close. Friday, the main event is the payrolls report. We'll hear from the Fed speakers, Bostic, Mester, through the rest of this week. Remember, Monday, US markets are closed for Labor Day. As if you needed a reminder, I'll be away tomorrow. I'll be watching payrolls come in, of course, from wherever I am. I'll catch you after the long weekend. I'll see you Tuesday from New York City. This was the countdown to the open. This is Bloomberg.
About that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Thursday, August 31st. Here are the top market stories that we're following for you at this hour. U.S. spending is still happening. I might have blown my budget this week. July spending beats, income comes in light, inflation holds steady. Maybe not though spending at Dollar General. The stock nosedives, the company slashing its forecast for a second straight quarter, hit by markdowns, damaged inventory, and theft. And dissecting the real economy, we're going to speak to Cummins CEO Jennifer Rumsey on growth, inflation, and jobs. From New York, I'm Alex Steele with Danny Berger over in London. Guy Johnson is off today. Danny, not to reveal the sausage making, but we really struggled with the question of the day today because it is really difficult to get a takeaway narrative here.
Yeah, maybe our question of the day should have been like, do you have a question that can possibly be answered in the world that we're living in? It's also confusing. You know, it's kind of unfortunate that we just came off the back of Jackson Hole where this data dependency question was really emphasized because the data is so confusing. I mean, we're dependent on the data, but like what in the world is the data telling us?
Right, and you can really see that within just the data we got this morning, right? You're still spending, but you have income slowing a little bit, okay. Core services ex housing is still elevated. And it's a really pick and choose. And this is why Mike McKee yesterday called the data weird. And I feel like that's exactly what we're seeing. It's also weird over in Europe. Maybe a little straightforward in terms of potentially a stagflation narrative evolving over in Europe, but nonetheless, weird.
Right. I mean, straightforward, but not exactly comforting. I think, Alex, you and I are looking for any certainty at all, which is how we landed on this question of the day. It would seem simple, but let's be honest, this is a really difficult one to answer. Have central banks done enough, whether it's Europe, whether it's the U.S., hey, even whether it's the PBOC, have they done enough at this point? Does the data give us any indication? Joining us now to do their very best at attempting to answer this is Bloomberg's Simon White and Michael McKee. Simon, let me start with you in answering what may be the impossible. Have central banks done enough?
It is a tricky question, you're right. So I think, well, it depends what you mean by enough. I mean, if you mean to kill inflation...
Let's go there. Let's go there with the Fed first. How about?
So I think, well, look, I think they've done enough now. But my view is I think inflation comes back up. And that's where central banks will have their real test, because by that point, growth will be in a lot more stickier place. It'll be a lot more obvious, certainly in the US, that growth is slowing. And I'm of the view, really, that a lot of the data we're seeing now, especially the jobs data, will ultimately be revised a lot lower. So I think optically things look better than they really are already. You've got the GDI yesterday, the huge discrepancy between GDI and GDP. Generally, GDP gets revised down towards GDI. So, you know, I think things are already, from a growth perspective, looking quite bad, or not as good as it should look. When it comes to rates, I think that, I think they're not going to do much more. If you look at the projections, real rates are basically 2% flat for the next year in the US. In Europe, they're more like under 1%. So there you could get a disappointment the other way where they do have to hike more. And the UK is the one that's a real outlier. I mean, UK real rates are going to be more than 3% in the next year on current projections.
So let's stay with the U.S. for a second, because to your point, like things maybe don't look as good as they are on the surface. I mean, to that point, Mike, like if you look at the PCE today, I mean, what, entertainment and services, like that's basically Taylor Swift and Barbie. That was up like 10%, right? Like there's only so many times you're going to go see the Barbie movie today, like I'm going to later.
Yeah, like you are?
Yeah, second time.
You haven't seen it yet.
Wow,
girl, I've seen it. This is my second time.
Well, Taylor Swift is coming to the movies, so we'll have
so
to
maybe
watch.
AMC gets a boost.
But it was pointed out that movie ticket sales have not really skyrocketed.
But it was entertainment, right? Because it counts for like the
entertainment went up, but that's not the real reason that the PC went up. It was basically in line, 0.2% for the headline, 0.2% for the core. For the latest month, we saw some rises in the year over year because it was base effects. But basically, we're getting what we expected out of it. Now, services ex housing, the J. Powell indicator, did go up 0.5%. That was a little more than expected, and it is maybe a little worrisome. but it's going to probably reverse given that a lot of that, it wasn't just Taylor Swift, but there was a lot of increase in the past 2 months in mutual fund compensation, believe it or not. So there's some tricky stuff in there. But basically, if you're asking the question, have central banks done enough in the U.S., it's an open question, but the answer seems to be probably. You've got people like Raphael Bostic this morning, the Atlanta Fed president, saying he thinks they've done enough. Let's wait and see what the lagged effect of the previous increases is going to be. But we're seeing inflation move in the right direction even without that. And I think that even Loretta Mester, who told us last week that she thought we probably would need another rate hike, said if we see progress, then we probably don't. And the bet is they're going to skip September, wait till November, and by that time we'll have a couple more inflation reports, and they may have a better idea of whether they've done enough. But we're also talking about if they go another one, 25 basis points, not a big deal. They're pretty close to the end.
Yeah. How much are you really going to feel about 25 basis points? Mike, and sort of the name of the game being trying to figure out the data and us getting NFPs tomorrow. Just looking at some of the stuff we've had this week, JOLTS a little bit softer. The Challenger jobs cuts report, that one spiked. Jobless claims falling to a 1-month low. So kind of resiliency, but maybe cracks. What have you made of what we've gotten so far, and if it says anything about tomorrow's data?
It's kind of hard to say that it says a lot about tomorrow's data other than what's expected, which is a slowing in the pace of job creation. That's what the Fed wants to see. That's why they raised interest rates, to sort of cool off the economy, bring demand for labor down, and therefore bring prices down. And so if we get the kind of numbers that are expected, 148,000 private sector jobs was the last one I saw, then the Fed is going to feel it's on track. It would only be if we got below 100,000, if there was a real collapse, that they might worry about going too far. But right now it does appear that things are proceeding as expected.
So this leads us to something else that Danny and I were kicking around, Simon, and that is the shape of mountains. And I mean that Hugh Pill was talking about how we need like a table mountain, right? And that's which meaning that you hike here, you stay here for a while, and then you slowly hike down versus like a peak. And I'm just wondering, what happens if we get different types of mountains from the UK, Europe, and the US? Particularly then if there's a risk that inflation reaccelerates. Like, where's the value then that you can make money off of in that?
Yeah, it's a nice idea. You know, the higher for longer done in language of a mountain. You know, I think it's going to be very difficult for them to get the markets to price that unless you see a re-acceleration in inflation. I think you do get that eventually, but I think in the next 3 to 6 months it's really not going to be clear enough. And therefore markets are going to be perhaps more focused on downside economic data. We know there's cracks in the job data. We know there's other signs of a slowing economy. And so trying to get the markets to price in this kind of like, you know, direct kind of flat line like a table mountain, it just doesn't happen. Essentially, markets will want to price one way or the other, either higher rates or lower rates. And they're going to be looking for lower rates, and that means that you're just going to get that bias for your 2-year rate. It's going to be very difficult, I think, for 2-year rates, certainly in the US, to given yesterday's question, to get much higher than 5%.
So is that the top mountain or the bottom mountain then? I think we got to talk about which one we're talking about.
Yeah, that's the bottom one. Yeah, I think that's
so
that's Mont Blanc and the top one.
This video came when like Guy was talking about mountains, and I was like, literally, what are you saying? And Guy explained me some mountains. So this is where this comes from. We're channeling him from vacation.
I just don't understand what the difference between a table mountain and a plateau are. I guess they're the same thing, but I think that's a conversation for Nat Geo, probably not for Bloomberg TV.
Exactly.
Yeah. Simon, I kind of want to take our question of the day and apply it to China, as I kind of hinted at, because we learned that the PBOC is also going to be lowering down payments for first and second-time home buyers. The yuan, it immediately rallies. I know the complaints have been, look, everything China is doing is piecemeal, but it's a lot. It's a lot of pieces. Are we anywhere close to saying, okay, maybe this is enough? Maybe they don't need to be handing out stimulus checks?
It's very piecemeal, you're right. They have to salvage the property sector. That's a really big, important thing, so they avoid going into, you know, a balance sheet recession. But they are still very reluctant to go into their flood-like stimulus, and that's really going to be a major holdback for now. But I just don't know how much patience they have, right? Because it's, you know, the more you leave a problem like that to fester, it gets worse and worse. So I think you're going to see this incrementally building stimulus. I don't think we quite get to stimulus checks, but they need to stimulate consumption. That's the real structural problem with China.
Yeah.
And the quick fix is to stimulate consumption. The thing is, they have to stimulate domestic consumption as well. If you stimulate, foreign consumption, you're just going to affect the trade account, and that's not what they want. So the policies around that, I think, are going to be very beneficial for them, and I think that's the direction they'll go in the short term.
And in theory, if you lower the mortgage rates for first-time buyers, maybe there's more money to spend and buy stuff, but that's going to take time to trickle through, the same way that tightening trickles through over a lag. Guys, thanks a lot. Really appreciate it. And we got the pictures in there of mountains. Simon White, Michael McKee, we really appreciate you guys. Thanks very much. Coming up, more insight into the question of the day. Have central banks done enough? Catherine Rivera, Chief Market Strategist over at StoneX Financial, joins us next. And as we head to break, we heard Michael McKee talking about this. Federal Reserve Bank Atlanta President Raphael Bostic saying policymakers need to proceed with caution when it comes to tightening monetary policy.
Based on current dynamics in the macroeconomy, I feel policy is appropriately restrictive. I think we should be cautious and patient and let the restrictive policy continue to influence the economy, lest we risk tightening too much and inflicting unnecessary pain.
Bad news has been good news.
Good news is somewhat bad news.
Bad news is now good news.
It would be really nice if good news could just be good news and bad news could just be bad news.
We're in that mode where the market is cheering weaker economic news.
We had bad news in terms of cooler data on jobs and also consumer sentiment.
The bad news in terms of weak data is kind of good news in the sense that it might mean the Fed is done.
The Fed is going to have some pressure.
Maybe the Fed's going to pause and that allows this cycle to carry on.
In the shorter term, there is some evidence that this is actually working.
That type of environment doesn't tend to last an extended period of time.
We're in this tricky part where you're coming down from really elevated levels and you're normalizing the data.
We need to be careful, though, that we don't get too excited too quickly.
That fine line is going to show
bad news eventually becomes bad news.
Those were some Bloomberg television guests weighing in earlier on the economy. If you're scratching your head, so is everybody else. Which leads us to the question of the day that we debated ad nauseum. Have central banks done enough? Want to go to Catherine Rivera, Chief Market Strategist at StoneX Financial. Catherine, what do you think? Have they done enough?
Well, private credit is certainly dropping. We saw the SLOOS data shows that credit to small firms is getting tighter. That should slow domestic demand, and we're seeing private credit is already contracting at rates we haven't seen since 2008. So I would say yes, let's see how this runs. But the truth is, Alex, we're debating between no more hikes or 25 basis points more. It's unlikely that they do anything beyond 25 basis points more. If this could happen in November, I think what we should all be talking about, however, is 2024. Are they really going to cut 125 basis points? And can that coexist with soft landing? And I think it cannot. I don't see the Fed cutting 125 basis points, which is discounted into the market, into equity pricing right now, and that coexisting in an environment of still strong labor market, both from syndicates, unions, as we've been talking about all morning, as well as independent labor, with inflation still above the 2% target. So I don't think that the Fed does do that. I think the Fed most likely holds for the vast majority of next year unless we get a recession.
In terms of pricing out some of those cuts, because it's a little bit more straightforward in what that would do to the fixed income market, Catherine. What happens to equities if we get to a point where we price some of those cuts out? Is that a steep sell-off in that case?
It is for the most rate-sensitive sectors that have discounted those rate cuts. So that's bad for technology. That's bad for communication services. That's not good news for consumer discretionary. These are intuitive things that we kind of all know the sensitivity to rates and how earnings are therefore discounted. That's why I like the more defensive sectors. I have for some time. They have not done well year to date because recession has not manifested. But I do think there are some telltale signs that 2024 will be less of a boon for those cyclical, those high flyer names than we've seen 2023 to be.
If we get then some kind of downturn, do you buy that dip? If that finally materializes, and is the downturn like a 5% thing, or is it going to be like a real one?
Yeah, I think that's the right question. So position for that swoon and then that swift recovery. So that's what I'm looking at now, trying to be ahead of market pricing, because currently we're pricing in nothing but a linear upside in my perspective. So ways to do that: protect yourself. You can have a cash, commercial paper still yielding very attractively. You can have gold. You can even look at tips. If you look at Jan 2025 real yields, that's about 3%. Nominal is about 5%. That's a 2% implied inflation. So if inflation does turn out to be sticky, doesn't revert to 2%, but is still something higher than that by that time, then you could be talking tips returns of 6 to 7%, which by the end of next year could be attractive if we're talking about a drop in the high flyers of the year, which have been the Magnificent Seven. We're talking about technology that's up, about 45% a year to date. So I would be thinking about at least positioning defensively and protecting at a minimum those positions that I think could be vulnerable in front of a repricing of Fed policy for next year.
This just kind of reminds me, I saw this note from BCA Research, which I kind of really love because I haven't seen the comparison done before, and I'm sure it has, and if it hasn't, I don't know why it hasn't before, but saying that there are no better growth stocks than French luxury and not even U.S. big tech, saying that they have massive and sustained pricing power. We're talking a lot about the consumer today. Is it fair to say if I want a growth stock, I should go buy LVMH, I should go buy Kering, get rid of all those tech stocks? That's not where it's at.
I think there's a lot of credence to that, Danny. I think companies with high quality balance sheets, high pricing power dynamics, and that's what you're referring to with Louis Vuitton, high pricing power dynamics. And that, I think, is going to be clutch in any phase of the economic cycle. But even more so if we're talking about a cycle of persistently high inflation and a Fed that is not going to be cutting and even could potentially be increasing. So, inelastic sectors such as when you've named staples, healthcare, energy, some communication services, some utilities, select discretionary, I think are safe plays, and one would be well positioned to accumulate those in a portfolio with a 12 to 18 month horizon.
Before we go, real quick, I mean, I hear you on the sticky inflation. What are the chances inflation actually reaccelerates?
Yes.
It doesn't go back to 10%, say, in Europe or anything, but like reaccelerates. How do you protect returns against that?
Well, that's where the tips idea comes into play, Alex. I think that if you're playing that implied inflation of 2% and you think it could be somewhat higher, then you do want to be long in those shorter duration tips, such as the January 2025s in terms of the real yield. I do think there are risks to sticky inflation. Of course, I do expect inflation to continue to decelerate from now through year end, but there is a chance for reacceleration next year if we maintain this labor market that is extremely strong, and we have the soft landing narrative that turns into reality, which is full employment, fiscal deficits of 8.5%. That in and of itself is inflationary, and an economy growing in a service sector-based economy where inflation is service sector driven. So that to me does not spell core PCE dropping from 3.5 to 2 for the foreseeable future.
All right, long short duration tips then. Catherine, thank you so much. A real pleasure to speak with you. Catherine Rooney-Vera at StoneX Financial. Now still ahead, X plans to collect biometric data from users. How are they getting it, and just how are they going to be using it? We're going to have the details for you next on The Startup. This is Bloomberg. It is 22 past 7 on the West Coast. Look, the lovely shot. That's new. The beautiful pier. We want to get to the Startup, where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts this morning, joining us now is Bloomberg Technology co-host Ed Ludlow. So X, formerly known as Twitter, is going to collect my biometric data?
Yeah, so when this story broke last night, the immediately obvious question was how? How are they going to do that? So I've spoken to X this morning, and this is what the company told me. First of all, this is only applicable to premium users, those that pay the subscription. What they're going to offer you the chance to do is submit a government-issued ID with a selfie, a picture. That will be used for two-stage verification, but it is from the government-issued ID where the biometric data will be extracted from, along with the selfie, a scan of that image for matching purposes. And their argument is basically, look, this authenticates you as a real human being, and one of the benefits that this will have, X tells me, is that it's going to really push back and fight against impersonation. And I don't know about you, Alex, about you, Danny, there are a few wannabe Ed Ludlows out there on the X platform that I've noticed. And
you've made
it. I know. Yeah. Some of them have more followers than I do, so it's interesting.
I think I've had one on Instagram, and I don't even know why, because I have like no followers on Instagram. I have no idea what they're aiming at. Ed, didn't Facebook, or Facebook still does something kind of similar to this?
So Facebook used to have a facial recognition software and opt-in on the Facebook platform, facebookappen.com, but they scrapped it at the end of 2021, basically citing societal pushback at the time. But how it works, you'll remember if you use Facebook or did at one time, that if an image was uploaded of you, there would be a recognition that that's you and you would kind of be automatically tagged. This is kind of a similar technology that X seems to be deploying, but the point of it more for authentication process.
Does anyone care? Like, are users in outrage? Like, or are they like, okay?
I think there's definitely, like, a few people have responded to me on X flagging privacy concerns. The big question I have is about GDPR in Europe in particular, because this does qualify as personally identifying information, right? What I would say is if you go on the X website under the policy page, it says pretty clearly that the policy is based on your consent. And as we just outlined, we've just explained how they're going to go about collecting it, but it's certainly caught by that. I think there are questions still to ask, but you have to give the benefit of the doubt of how effective this will or won't be. People still complain about the pervasiveness of bots and impersonator accounts, and all I'm saying is X are telling me they want to clamp down on that. They also had some other news, guys, I don't know if you saw, but they're offering video and phone calls over the X platform, or will do, without needing to register your phone number with it, a phone number free service. It's just another example of X, the everything app.
Yeah, I mean, I'm sure a lot of apps already have, I don't know, all of my data under the sun. What's another one? Ed, thank you very much. Right. Bloomberg's Ed Ludlow. Of course, you can catch Ed and Caroline Hyde on Bloomberg Tech. That comes up in around 90 minutes. Alex, we've got to talk about this story. A love story between AMC and its shareholders. The stock jumped after Taylor Swift announced an Eras Tour film that will begin airing at AMC theaters on Friday, October 13th. Alex, you and I were just talking about how in the PCE data, entertainment was a big part of the spend. Is this going to just fuel it another leg higher? Thank you, Taylor Swift, for the inflation.
Yes, and they're saying that AMC said they're going to have a minimum of like 4 shows a day. But this is so smart, because if you want to jumpstart movie theater tickets, like Mission Impossible 7 isn't going to do it. Like, that was clearly Barbie and now clearly Taylor Swift. And AMC is a nice meme stock for people. So I feel like the combo should be really interesting.
Okay, I have a small rant that I'm going to make and then abandon. Make more movies for women. We go and watch them. That's all. This is Bloomberg.
Authority.
We're about an hour into U.S. trading session. Let me know if you heard this before. Higher stocks, lower yields. That's pretty much the playbook right now. Oh, and lower volume. Abigail, do a little tracking the moves. Abby?
Indeed, and because of that playbook, Alex, on the week now, we are looking at a 2.8% gain. This means that the S&P 500 on the month down just about 1%, heading to its worst month since February of this year as opposed to December of last year. So in the last 4 days, including today, we've had this break for stocks that is frankly giving a reprieve to the bulls. Now, to Alex's point relative to yields and the dollar, let's take a look at what's been happening over the last 5 days, because here you have it. So the dollar's not down a huge amount, down 0.3%, but take a look at this 10-year yield, down 14 basis points. This, of course, makes some of the high-tech stocks look less expensive than they had been as the valuations look more attractive, more appealing as money is staying in the system, potentially, because we've seen these whipsaw back and forth many, many times. Tech, interestingly, on the month also down just about 1%. Now, it had been down 5%. When we put this together for the S&P 500, this chart is just so interesting. We've been looking at it for a couple of weeks now. So here you have the August downtrend. Again, there had been a decline of almost 5%. We are clearly breaking above that this week. It started, frankly, it started a couple of weeks ago, but it really started with Fed Chair Jay Powell's speech, which investors are somehow taking as a more dovish sign. We're breaking above. The one thing I would point out, and something that makes me think that we could see some more challenges to a sideways trend at the minimum in September, is the fact that you have equidistant bottom. That tells you that the sellers are more excited, more confident than the buyers that have yet to take out that last high. But let's see, of course. On the day, let's take a look at some of the movers beneath the surface, and we do have quite a few here. Salesforce.com off of its highs, but nonetheless higher on a good quarter and outlook. Margins improving. Amazon is higher, Adobe and Broadcom. So we do have a broad-based tech rally here for sure on the last day of August, Danny.
I feel like that was an excellent accidental pun, a broad rally with Broadcom up. Beautiful, Abigail, no notes. Abigail Doolittle there. Thanks so much for the roundup. Look, tomorrow we're going to get more reads on this economy. We're going to get the read on the labor market. We're going to have NFPs, the U.S. payroll report. Amy Glazer, Adecco Senior Vice President, joins us now. Adecco is, of course, the world's second largest HR provider and temporary staffing firm. Amy, the data's been confusing, to say the least. How would you, at this moment, from what you see, how would you characterize the resiliency of the American labor market?
Yeah, it's a great question. I think we're still in a talent-driven market, and the job seeker is still in that driver's seat. With 1.5 jobs available for every candidate out there looking, we're going to continue to see growth for the upcoming months.
So walk us through some of the details first. So we had seen job switchers make a lot more money if they switch jobs, and getting better terms, et cetera. Are we still seeing that to the same extent?
Definitely not. That has reduced. You're seeing, you saw the quits numbers decline over the last month, and I think employees are kind of sitting and taking stock. I also think we have to attribute some of this to the work being done by companies. You're seeing increased flexibility and a lot of non-monetary positives that may be making up for some of those huge gains we were seeing in sign-on bonuses, retention bonuses, and anything monetarily related.
There's this argument I saw from State Street, Michael Aaron, that I thought was interesting, Amy. Basically, there's been a structural change. The data isn't capturing it. There's a drop in female labor workforce participation, more boomers retiring, fewer foreign-born workers, the gig economy, those types of things. Would you agree with that we're in a structurally different labor environment?
Absolutely. And I think, look at the gig workers, for example. By 2027, gig work is expected to exceed just our normal day-to-day work opportunities. So I think we're definitely in a different environment we were in pre-pandemic, and employers that are continuing to be flexible and agile are really the ones that are going to be able to capitalize on our new world of work.
So in a weird way, Amy, are we underestimating the strength of the labor market, understanding that the word strength doesn't mean the same thing that it did 5 years ago?
Yeah, I think that's a really good point. Every month, everyone holds their breath waiting for the report to come out on Fridays, and oftentimes we've been pleasantly surprised over the last couple of months. I think we're just really getting to the point right now where it's not too hot, it's not too cold, there's some positivity for the employer, and there's still lots of availability out there for the candidate. So although we can look at historical trends and data, really focusing on in the moment what's true today is what matters.
Amy, you sent through this report, the Innovation Foundation, which of course working with Adecco Group, that put together, that there are more people unretiring, coming out of retirement to work. That kind of makes me sad because I'm like, no, go enjoy retirement. What's going on there? What's driving that trend?
So I think there are a couple different things. From an inflation and cost perspective, obviously a lot of folks are looking for opportunities to supplement their income and make some more money. But what we really see in kind of the heartfelt stories are those that miss that sense of purpose they achieve while entering the labor force and being part of the world of work, the sense of camaraderie and community of being with others, and frankly, the sense of pride a lot of folks take. It's a great story for employers. You know, as the baby boomers have retired, we've lost a lot of our skilled workforce. And having the ability to bring them back in and help train that future workforce is really a true positive we're seeing right now.
Which hence also the gig economy, like maybe that's a good fit too, so you don't have to commit to working your 40 plus hours a week. Okay, so where are the cracks? Like where are some signs that there is some softening?
I think some of the concern when you look at that number, it sounds great, 1.5 jobs to every single seeker. The challenge really becomes is where are those jobs? And you almost have to look pocket by pocket, geography by geography, and sector by sector to determine where those are. We continue to see resiliency in like healthcare and creative and marketing and some of the skilled trade items, but it's really a pocket by pocket look. There's not one large sector of bad news, but it's really, you ask an employer who's facing a challenge of finding workers this holiday season when some of their workforce may have migrated to a different part of the country. I think that's where we see the challenges.
Amy, just quickly here, how much of the challenge is just skill? Sure, there's people, but you can't find the right skill of people.
So skill continues and will be a challenge over the next couple of years. I know we've seen this talent gap as the baby boomers have retired. So that's a piece of it. A piece of it's skill and a piece of it's will. Are the jobs that are available jobs that folks are willing to take? And that's where I know we saw quite a bit of wage inflation over the last couple of months. And frankly, we'll see it again in seasonal hiring this upcoming peak season.
Hey, Amy, we got to leave it there. We still haven't gotten to the strikes. There's so much more to cover, so please come back. Amy Glazer, Senior Vice President over at Adecco. All right, coming up, we get ISM Manufacturing coming tomorrow as well. We're going to get the Real Economy Read with Jennifer Rumsey Cummins, CEO and Board Chair. She's going to join us next. This is Bloomberg. Chicago PMI coming out earlier today. Not as bad as expected, but still below 50. Tomorrow we're going to get another read on U.S. manufacturing with ISM numbers coming out. There's been a 9-month contraction in the sector, the longest stretch since the Great Recession, but maybe we're finding some stabilization. So we want to get the bird's eye view here of what's happening in the industry with Jennifer Rumsey, the CEO and board chair over at Cummins. Cummins designs, builds, and distributes diesel and natural gas engines, and she joins us now from the New York Stock Exchange. Jennifer, it's a true pleasure. I know it's a broad stroke, but if you had to describe the U.S. economy, just the U.S. right now, how would you be describing it?
Yeah, so from where Cummins sits, we're serving commercial and industrial applications. We see some of these broader economic indicators like rising inflation rates and some slowing in manufacturing. Certainly, we've seen some softening in indicators in our industry like spot rates and used truck prices. The reality is we're coming off a record revenue first half for Cummins, and what's really happened is we saw our customers with a lot of demand and a lot of use of their trucks and other equipment over the last couple of years, and supply constraints prevented us from meeting that demand. So we're really seeing an extension of demand happening and projecting some softening in some of our markets as we go into the second half of the year. So aftermarket and heavy-duty trucking, we think is going to be down a little bit in the second half of the year, but still quite strong, frankly.
Is that kind of more of a normalization then, Jennifer? And then where's the line between normalization and downturn?
Yeah, I mean, we are in a cyclical market. It's common for us to see rising and falling demand over the years as the economy shifts. And this is just frankly not a typical cycle because of this pent-up demand that's out there. They've used trucks. They've got an aging fleet. The next generation trucks and the engines that we're providing are more fuel efficient. So there's other factors that are driving customers to continue to demand our products at a pretty high level.
So if industry forecasts are looking at truck production to be down in 2024, how is that different than like a previous downturn or a previous sort of stagnant economy that you're used to?
Yeah, I mean, Cummins has not yet given guidance for 2024. If you look at what ACT is predicting, a little bit less depth in that downturn, perhaps, than what we would typically see in our industry. But we're continuing to watch what happens as the truck manufacturers start to open up order boards for next year. I think it's going to be important to watch what happens with those order board demands.
Well, the EPA had finalized some new emissions rules for 2027. Do you expect that to fuel a lot of pre-orders? And how tricky is that, I guess, ahead of an election year of all things?
Yeah, I mean, for Cummins, we have continued to embrace the need to meet more stringent emissions requirements in our industry as a way to drive innovation and growth for the company. We've seen a lot of growth on the back of those regulations. We see the need to decarbonize our industry as another growth opportunity for us. And so you will see some customers making decisions on when they purchase equipment, maybe some timing driven by those regulations. The great news for us is we now have nationwide standards in 2027 between EPA and CARB. And also, as I said, these products are continue to have higher fuel efficiency, which is good for our customers and running the operating costs in their businesses.
On the flip side, though, I feel like not the regulation part, but the technology is changing really quickly, and sort of what qualifies as quote-unquote green and the cleanest thing is also changing really quickly. Are you at a risk of like making the stuff that all of a sudden in 6 months doesn't count anymore?
Yeah, I mean, I think there's an important opportunity for us to decarbonize our industry in a way that is good for the environment and good for the economy. What that means is we have to drive true CO2 reduction through the infrastructure and out into the actual equipment. The reality is it's going to take time for our industry. There's a variety of applications and how this product gets used, and our customers are running businesses. So they're trying to understand what are the solutions that allow me to meet regulation or maybe my own sustainability targets, and how do I do that with technologies I trust and things that are going to make my business successful. And this is a real advantage for Cummins because we have a whole portfolio of solutions, and we're helping our customers pick what's right for their business at the right time.
Is it just that knowledge thing, Jennifer, or are there other big barriers that prevent the speed of adoption of some of these greener technologies?
Yeah, there's really multiple barriers and factors into this. First of all, cost. So many of these alternate technologies cost more today. The costs need to come down. Infrastructure is another big issue. And some of the technologies aren't even capable today of meeting customers' needs when you think about range requirements or weight requirements. So what we're doing is driving innovation through Accelera by Cummins in applications where it makes sense, where there's incentives and factors that are driving adoption today. That will allow us to bring costs down and advance the capability of these technologies. It's also why we're continuing to invest, and we're making a $1 billion investment in our U.S. engine plants for these fuel-agnostic platforms. So reducing CO2 of diesel engines can have a big positive impact on the environment. And so we have a pretty clear view on what this looks like. It doesn't mean it won't be messy and complicated, but the U.S. is making important steps with some of the incentives that are starting to drive adoption of these low and zero emissions technologies and the infrastructure build out to support it.
Okay, Jennifer, so we had PCE today in the U.S. We get jobs tomorrow, so let me get your take. Let's start with jobs for a second. What's your job market like? Give me some details. Like, are you hiring? Are you just not laying off? Or are you hoarding? Like, what's your relationship with your labor force?
Yeah, great question. So, first, in select areas, we continue to hire where we're investing in the future. We also recognize that we believe we've reached a peak for our business in this cycle, and so we're prioritizing those investments and being thoughtful about where we add headcount so that we're prepared for a potential downturn. The labor market continues to be pretty tight. It's not as tight as it was a couple of years ago, where it was very hard to get engineers and people in our manufacturing plants, but it continues to be challenging. And so we want to continue to invest in our people. And so one of the strengths of Cummins is our investment in our people and the environment in the company, and make sure that we are attracting the best talent and retaining key talent for our future.
So Alex went to the jobs data. Let me go to the inflation data. You mentioned some of the high costs of renewables, but if we just take a step back overall, how close are we to something like normalization? Is it months? Is it years?
Yeah, I mean, we've continued to see some inflation pressure. Some of those factors like metal markets have decreased from where they were over the last couple of years, but they're still elevated. And so inflation and supply chain challenges is less of an issue than it was a year ago. It's still a challenge for us in certain parts of our business. Electronics, for example, has been a real challenge, and so it's improving. I wouldn't call it stable and certainly not normalized back to what we would have seen 4 years ago.
And then to end, what's your view on China? How's the China market? What do you expect that economy to evolve?
Yeah, so, Cummins has been in China for decades. It's a large market and one that we plan to continue to participate in. Last year was really a very low point for Cummins business in China because of the COVID lockdowns and the weak economy there. We've seen some improvements in 2023, but that market is still very low. And we expect to see some softening in the second half, which is typical of their cyclicality. Hopefully we'll see improvement in the coming years as we go into next year. There's definitely recognition of the economic challenges there and some attempts in that country with lowering interest rates to try to stimulate that. But we've not seen anything significant. So it really is still pretty low for us. That said, we've invested in a lot of new products there. So we are and have the opportunity to continue to outgrow the market with those new products.
Wow, I'm glad you stopped me from interrupting you, because that's interesting. Grown in China, new products. Jennifer, I'm afraid that's all we have time for. Thank you so much for joining us. Jennifer Rumsey there, CEO and Chair of Cummins. All right, coming up, an earnings story, a big one. UBS posts the largest ever quarterly profit for a bank. That follows its emergency takeover of Credit Suisse. We're going to have all the details for you on today's Wall Street Beat. This is Bloomberg.
Time now for Wall Street Beat. We cover all of what Wall Street is looking at around the world, all in banking and finance. And today we got to look at those record results from UBS this morning. We're going to hear from the CEO later on in the next hour. But let's dig into some of the details. Bloomberg's Sally Bakewell joins us. Man, Sally, the numbers were huge. But, we have to put that into context, right?
Exactly, yeah. Of course, the numbers, it posted its biggest quarterly profit, but this really was an accounting gain from the acquisition of Credit Suisse, which it, paid a certain price for that was much lower than the actual value of its assets. But if you look at the underlying numbers, they are still pretty positive. And a key one was inflows. UBS saw 16 billion of new money flows, which is a pickup in client activity. And that's important because it shows perhaps, the stabilization rather than any feelings of contagion from absorbing the CS brand.
And I think about, and Sally, you of course know this much better than me, how it gets politically tricky for a bank that's had government help to be posting such big numbers, not to mention shareholders that for Credit Suisse got a lot less than UBS is now saying it's worth. What difficulties, what sort of dangerous doors does this open?
Indeed, and when we heard from Sergio Amotti, the CEO, he sounded confident about the progress so far, but he was also very measured. He's catering very much towards what shareholders are eager to hear, and what other stakeholders like the Swiss government want to hear. And so, the focus is very much now about the integration and executing the integration. And there are, of course, landmines ahead. Very interestingly, we just heard this week from the Swiss regulator. The Commission is looking at sort of market concentration stemming from a combined CS and UBS business in Switzerland. So, whatever the findings are of that, the deal has effectively been pushed through and it's done and dusted. But it's an unusual news to hear, but it just shows that there are hurdles and there are potential issues ahead.
When do we get all the job cuts? And it's going to be significant.
It's going to be significant. So we heard today that they're expecting to make about 3,000 domestic job cuts, and this is what Amotti calls, painful realities of the integration. And that will also help. That's a big contributor to the more than 10 billion in cost savings. But we also know that job cuts could be, a fraction of what they actually end up cutting, because the acquisition of Credit Suisse has increased UBS's workforce by about 45,000 to 120,000, and Bloomberg has reported that they ultimately want to reduce the overall headcount by 30%. So the job cuts could be much, much bigger.
Yeah, and again, politically, maybe doesn't look so great. Hey, Sally, thank you so much for that roundup. Bloomberg's Sally Bakewell, thank you very much. And we're going to bring you highlights of our interview with UBS CEO Sergio Amotti in the next hour. Now, the good news at UBS is helping to lift European equities, along with some other individual company news. We are looking at stocks gaining about 0.1%. But the more interesting market moves are potentially on what's happening with both currencies and bonds. The euro is getting pummeled today, down about 0.7%. The weird thing about this is euro down, euro weaker, yields down too, by a lot in Germany, 2 years down 10 basis points on a day when we had hot inflationary readings for both France and the overall euro area. At the same time, we also had an inflation reading for Italy that came in less than expectations. But Alex, they're all stuck in that 5 to 6% range. I know we're going to talk about this more, but you got to imagine that the stagflation conversation, that's kind of what we're pricing in at this moment.
Well, yeah, and if you do the stagflation scenario in Europe, what does that wind up meaning then for the U.S. when things seem to be going okay? It does seem to me that the trade-off of growth and inflation seems to be much harder in Europe. Or is Europe just sort of like 6 months behind where the U.S. is when this was starting to come into the foreground?
Yeah, and I have to say, I do feel kind of bad for the ECB. Of course, this is an impossible decision, so in that way. But there are all these comparisons always made. The ECB is like the Fed's little brother, just kind of following it wherever it goes. If this means they got to follow it to pause, they're going to have to do some justification as to why they're pausing, that they're not just following the Fed. All right, coming up, a lot more conversations. John Kolovos from Macro Risk Advisors joins us.